Welcome, everybody. Thank you for joining us for the first quarter of 2025 for the Feldmeyer Forecast. Today, Derek and I will be hosting the call and looking forward to getting all of this information out to you. We had a very positive 2024 and have a positive outlook for 2025. So let's get started. Topics that we're going to cover today, kind of a high-level overview of 2024. We know that market performance and returns were very strong for the S&P 500. And we also take a look at what actually happened with the GDP and growth there. We're going to take a look at continued trend of inflation and where does that stand as of the end of the year. We also have a new administration starting this year, this January, just here in a couple of days. And there is a handful of things that have been discussed by the Trump administration, either that will positively affect the market or could potentially cause some hiccups here in terms of market growth. So we'll discuss those and some of the expectations we have there. And then also, what is the expectation for the market and growth in 2025, and where do we see those returns coming from? So as we get started taking a look at 2024 and an overview on things, if you look at the bottom of this chart, you'll notice that this is looking and measuring at things quarterly. But when we look at those last three bars, that's 2024. The numbers for fourth quarter haven't come out yet since it's so close to the end of the year still. But the biggest thing that we look at when we're looking at GDP and the growth in GDP throughout this year is this blue bar right here. That blue bar is consumption, so U.S. consumer spending, basically. And as you can see, that is the vast majority of what is making up GDP for the year. 68% of our GDP is made up by the consumer and growth there. So when we look at strength of the consumer, how has the consumer been able to support the economy for as long as they have? One of the biggest reasons for it, we have had 20 months of consecutive wage growth outpacing inflation. So when we look at people's ability to spend, that's where a lot of that is coming from. We also have early indications that the holiday spend was stronger than it was in 2023, and that there was a substantial amount going on there. We also know that due to market returns over the last year, anybody who is drawing on their investments for spending are able to do that more so, just due to the positive investment returns that we've seen in the last couple of years, and their ability to then be able to reinvest that into the economy. So when we look at overall high level, look at things in previous quarters, we've looked at kind of the consumer's balance sheet of how much debt versus income and some of those metrics, and thought we would change it up a little bit, just looking at purely GDP growth and continued strength of the U.S. consumer, which is a very positive outlook going into 2025.
Another thing that we were closely watching last year, all the way through 2022, was inflation. And that is one of the two main drivers that the Federal Reserve looks at when they are considering cutting rates or increasing rates. And since June of 2022, we have seen inflation come down below 3%. And the Federal Reserve's goal is closer to 2% than where we are today. So I don't know if we'll get all the way down to 2% exactly, but we should continue to trend in that direction. And a couple of the pieces that have helped us reduce our overall inflation has been energy, which is the green line, which has been deflationary, the cost of energy coming down, as well as if you look at that orange segment, that is core goods. Those are goods that are not including food and beverages. So anything that you would go to Target or Walmart or buy from Amazon that is not food related, that is a core good, we've actually seen those prices come down, which is nice for the consumer, which helps them be able to afford more. The cost of shelter is still increasing, whether that is in rent or purchasing homes. But what we have seen is this big blue line, it has started to at least trend downward, that it is not continuing to increase at the rate as which it was, has been. So this slide is from JP Morgan with their expectations, as well as other various economists that we should continue to trend closer to 2% than 3% by the end of the year, assuming everything continues to stay the same, if we just stay on the same current track that we are on. So the question is, what would change that might make inflation a little bit different?
Mm-hmm. One of the big selling points to the Trump administration during the election season was the discussion of tariffs and using tariffs to not only balance the budget, but also to be able to negotiate better trade deals with our trading partners. On the last slide, I don't know that it was in the GDP slides, we saw that we do have a negative GDP growth when we look at imports versus exports. A lot of that is due to the fact that our goods are made in other countries and we import them here. But we also have to look at what are the underlying deals associated with being able to bring goods into the country. What Trump has proposed is increasing tariffs on certain countries to be able to not only increase our budget, reduce the deficit there, but also to negotiate a better deal. The issue that the economists have with it is if he were to actually do what he has proposed, you'll notice that over the last several years, I mean, starting in the 90s, we have had, even back into the 80s, we have had a pretty steady and look at tariffs that have not really gone above that line. What Trump is proposing, if everything that he's proposing actually were to be implemented, is this line. So you can see pretty obviously that it would have a pretty substantial effect on things because that cost is typically, historically, passed through to the cost of goods in the United States, which means the consumer is now paying a substantially increased price for the same goods. Do we think that that big line will actually get implemented? No, we don't. We don't think that they're actually going to go through with this because they know that it would stunt economic growth and would be a huge burden on the US consumer. However, our expectation is that they will use those threats of pretty big numbers for tariffs to be able to negotiate better trade deals. We do anticipate tariffs at a higher level, but nowhere near what it is that they've actually said publicly.
The next thing that the Trump administration has talked about is balancing the budget, right? We need to reduce our spending. We have the Department of Government Efficiency and everything else that we're going to do to help balance the budget. The issue is if we actually look at what our federal budget is, on the left side here, this is what we are spending. And there are a few things that we actually look at the expenses. We have interest here at the bottom being 15% of our budget. So all the money that we've already borrowed, the interest that we have to pay on that every year is 15% of the budget. The next three lines on top of that, Medicaid, Medicare, and Social Security, those are a big chunk of it, which we don't think are really discretionary spending. And then we have other mandatory spending as well. These are government contracts that have already been signed and that we are obligated to pay. And then the defense spending is 14% of our budget, not technically non-discretionary, but it has been years and years and years since the defense spending has been cut. So that leaves us with 12% of our total $7 trillion budget that is considered non-defense discretionary spending. So in order to try to balance the budget, we'd have to try to reduce that 12%. The issue is what's included in the non-defense discretionary spending, things like the post office or other things that the government helps provide. So it's just impossible to cut that down all the way to zero. Even if it did, we still don't have enough income to make up that full $2 trillion deficit. So the one thing we talked about is increasing the tariffs to help balance that budget. So that is one thing that we will look at. But with Trump being in office, we are under his Tax Cuts and Jobs Act that got enacted in 2017. That was set to expire at the end of this year. This was going to be the last year of that. It is expected that he will extend that and probably deepen and widen it, meaning that it's not only going to not sunset, but it is actually going to increase our budget or our deficit over the next 8 years. So the question is, if this happens, then what are we going to do? So the big takeaway, if you've met with us over the last several years, chances are you've heard us talk about the value of Roth. And while the going is good and tax rates are as low as they are right now, and will hopefully continue to be for the next 7 to 8 years, we want to continue to take advantage of being able to get money into Roth while we can, if it makes sense for you. The other thing is Social Security is a big chunk of our federal finances. And on January 5th of 2025, the Social Security Fairness Act, it was a bipartisan bill, strongly supported by both sides, signed into effect by Biden. And it has increased our Social Security obligations because it reduced government pension offset and the windfall elimination provision. So eliminated them. So if you have previously been affected by that and had a public pension and your Social Security was reduced, that has gone away. You can now apply for Social Security benefits that you would have been entitled to. The concern there is Social Security was set to be insolvent by 2020 or 2033. I'm sorry. So about 8 years away. And by allowing 3 million more Americans to participate in Social Security, that date is going to be moved up. So there are going to be some real hard conversations that our government is going to need to have about Social Security, our income, and our spending over the next couple of administrations.
Mm-hmm. The other point of note in terms of things that could sway the economy one way or another over the next year or so was the discussion about mass deportations and immigration. Long story short, what we have expected and what most economists and political analysts are also agreeing to is that they do not think that mass deportations will be realistic in any way, shape, or form. The cost to do it is in the billions, if not more, and the feasibility of the amount of people they would have to hire, the amount of facilities they would have to create, the amount of judges and border patrol and everything else that would have to be ramped up is just point blank unrealistic. So while we may see increased deportations, the mass deportations that they were initially discussing is just not feasible. So while that could have had an issue for labor supply and for for inflation with some of those jobs potentially being open and not having people to fill them, we don't expect that we're going to see that in anywhere near what was originally anticipated. So that is not as big of a concern at the current moment. When we look at, let's shift gears a little bit and talk about the market and our expectations for 2025. What we see here is the S&P 500 year over year earnings per share growth. So we're really looking at profitability of companies within the S&P 500. What you see here on the left-hand side is that 2024 profitability overall of the S&P 500 in terms of earnings was 9%. Expectation for next year is 14%. The year after that, they're very tentatively, JP Morgan is very tentatively saying 13%, but we'll just have to wait and see how things play out. It's an awfully long way away to make that prediction. But we do anticipate strong earnings growth for 2025. When we look at profit margins, we also see that we have seen a lift in terms of profit margins for these companies as well. That also helps with reduced inflation, has made it so that people can afford to go back and purchase a handful of these things, which reduces the profit margin compression that we were seeing even a year ago. So we do have a very strong outlook in terms of the ability for these companies to be profitable. That does not mean that their share price is directly correlated, that we expect the S&P 500 to be up 14% this year, but there is a direct link between the two, because if companies aren't profitable, their share prices will not appreciate at the rate we'd like to see them.
And looking at the performance of last year in the stock market, once again, the Magnificent Seven, or the Mag 7, was a big driver of the growth. So if we look at just the S&P 500 return on this left chart, we see if you would just buy the index, you would have a growth of that gray line. The issue is the Meg 7 has way outperformed all of its other 493 peers in the S&P 500, and we have seen growth of those companies be a little bit lower. Now, where do we see things going forward? Yes, we still like the Mag 7. We still think there is room for growth, but it is unsustainable for them to continue the same growth rate. And we've even seen that in 2023, they grew by 76%, and last year they only grew by 48%. So the rate at which they are growing is continuing to kind of decline a little bit as we see other stocks catch up, other sectors catch up. This year, we think that there could be a really good opportunity in small companies. Those are undervalued compared to the rest of the market. So as we are looking at our model portfolios and where we want to invest some of those funds, yes, we're still invested in the Mag 7. We're not getting out of them by any stretch of the imagination, but we are starting to add more allocations into other sectors, other markets as well.
And if you look at the top right-hand corner, this is expectations for 2025. You can see that the green bar in terms of earnings growth, there's your Magnificent Seven, but the blue is other companies that are catching up. When we look at the rest of the chart, we see very little in terms of the blue, if not some negatives in there. But we anticipate positive growth coming from those companies as well, but we don't dislike the Mag 7 because we still expect positive returns there as well. When we look at expectations in terms of certain sectors, one of the things that we look at is cash that's being held by a lot of these different sectors in terms of where we like to invest, mostly because cash on hand, one, means some strength and stability within the company because they have the ability, should there be any sort of disruption in the market, to be able to use that cash to reinvest in R&D, to be able to hold inventory, to be able to have a safety net. So where are we seeing a substantial amount of cash held? Well, tech, for one, not necessarily surprising as their growth industry and need to have a fair amount of cash on hand for R&D and reinvestments. We also see that in communication services and, interestingly enough, real estate. Awful lot of real estate companies that are waiting for rates to just nudge a hair lower for them to be able to take that cash and now reinvest at a lower rate and get in the market there. Plenty of other good options that we see as well. The positive and the one thing to really note in this discussion is that, like any year, we anticipate intra-year volatility. As the first 100 days of the Trump administration commences, we will get a pretty strong idea in terms of their priorities and their outlook on things, which will probably give us an indication of where they're going to go for the next 4 years. If that causes any volatility then or throughout the rest of the year, as we normally see, a lot of these companies still have strength in the fact that they have cash on hand to be able to weather any sort of very short-term market volatility on things.
So with that, as we wrap up here, we just want to kind of recap our takeaways. And 2024 was a really good year. A big chunk of that was driven by consumer spending. We will continue to see the consumer be strong. There have been 20 consecutive months where wage growth that the consumers are making have outpaced inflation. So not only do we have low unemployment rates, we also have a strong consumer because they're making more money, and that's outpacing inflation for 20 months in a row. Inflation has been manageable, and like I said, those jobless claims are very reasonable within expectation of where the Fed wants to see. We will continue to monitor any changes that will be implemented or discussed by the next administration and make sure that we make adjustments as necessary, whether it's to our investment portfolios or our outlooks as well. And then as long as we continue on the current path, we are very optimistic, or as Ben likes to say, cautiously optimistic about the continued economic growth and what that means for the investment markets, both stocks and bonds for 2025. So with that, I appreciate you guys joining us here for our first quarter Feldmeyer forecast. And we look forward to seeing you again at the next one.